You know, folks, we're from New York and we have a reputation of being loud. Norman said good morning, and all I heard was good morning. One more time, good morning. Good morning. Thank you. All righty. By the way, I forgot my watch. I left it at home. So if I check my iPhone, I'm not checking text messages. I want to make sure I have the time because we're ending at 12:10. Is that correct? And I respect everyone's time. So if you see me just hitting it, it's for a good purpose, okay? What we want to do today is take a look at Section 162 of the Internal Revenue Code. And it is a workhorse. You know, in doing the tax resolution, there are many times that the IRS and a taxpayer do not agree on what the answer should be. And so what happens is they often go to tax court. And probably the single most litigated issue in tax court is Section 162. Are expenses ordinary and necessary? Is it a trade or a business? That kind of thing. So the most litigated of all is 162. So it's worth our time to take a look at 162 and remind ourselves of what it's all about. One thing we're not going to do is we're not going to get a list of expenses that are ordinary and necessary and just take them off the tax return, because that's impossible to do. If you look, and by the way, is anyone new here for the first time that hasn't? All right. You'll notice that thing is blank. That machine is shut off. PowerPoint is one of the worst inventions of all time. All right? I do not use PowerPoint. All right? I read the order. Tomorrow, yeah. Mama Travato says I got to use it with her tomorrow. But seriously, I don't believe in PowerPoint. Hardly any instructor knows how to use it. Most of the time they're reading the thing, and people, what are people watching? They're not watching the speaker. What are they all watching? The screen. Agreed? All right, I speak the truth only. So in any case, it's not going to be a list because we don't know. And if you look at your handout, and I'm going to refer to the handout, so hopefully you either have it printed out or you have a iPad or whatever device you have where you can see it, that everything about Section 162 involves the three most important words in the tax world. What are the three most important words in the tax world? Look at the first paragraph. Facts and circumstances. Everybody say it. What are the three most important words in the tax world? They control everything. So if you're talking about Section 162, it's always about facts and circumstances. And one of the things you want to determine is does your taxpayer have a trade or business? In the Internal Revenue Code, trade or business is referred to in many, many places, but there is no definition of what a trade or business is. How do we know what a trade or business is? From the common law. The common law meaning the law that has evolved from court decisions, okay? So the common law tells us that what a trade or business is. Do you all remember Section 199A a couple years ago when it was started? They issued 252 pages of regulations. 252. In the 252, there were only 2 court cases in the entire 252 pages. Pages. I say pages? Pages. One was Higgins, which is in your handout. And what Higgins said, it's a Supreme Court decision, and it says to determine whether or not you have a trade or business, it is a matter of fact. There has to be a factual determination, all right? So in order to say, if someone says to you, can I take these expenses? Your first question is, do you really have a business? All right? And so what you need to do is look at the facts. I can't overemphasize it. I'll probably say it more times than you can hear me say it, but you need to understand that. The second case is, so what Higgins does is tells us there is no absolute answer. Higgins says we always got to look at the facts. So what facts do we look at to determine whether or not something is a trade or a business? Well, a second Supreme Court case called Gretzinger, and it's in your handout there, that you can see the citation, is the seminal case on what constitutes a trade or business, all right? And basically what the court said, Gretzinger, interestingly, he bet on dog racing. And at that time, before Gretzinger went and he took business expenses, and the IRS said, no, you don't have a trade or business. Trade or businesses, what do? They sell things to people, or you provide a service to people. That's what always businesses were thought to be. Either you gave a service, a doctor, a lawyer, or you sold something to somebody. But betting on dogs is not a trade or a business. But Gretzinger said, yes, it was. And what the Supreme Court did is they looked at the case and they established for us the test to find out whether something is a trade or a business. And they said it only requires two things. There has to be continuity and regularity. That's the first one. The activity, let's call it an activity before we call it a business. The activity must be conducted with regularity and continuity. And the second thing is, it must have been entered in to make money. If you have those two things, you have a trade or a business. There are some revenue rulings that a lot of people cite it. I forget the name of it, but it was about a guy who wrote a book. He was an author. He only did it one time. What did the IRS conclude? It wasn't a trade or a business. Why was it not a trade or a business? Because he did it only one time. There was no continuity and regularity, all right? So what Gretzinger does is it established, am I okay? Yes, sir. It established the fact that those are the two conditions, all right? You can see the fourth paragraph down? An activity conducted with continuity and regularity and with the good faith intention of earning income or making a profit. One of the things you see in the tax court is they'll often say, this guy, I mean, I'm paraphrasing, they're not that way. This guy's an idiot, he's not going to make any money. But they look and they say, he actually thinks he can make some money. What is your intention, all right? So it's very important that you understand that. You notice in the handout, I also have something that at one time was important. It's not important anymore. Can an employee be in a trade or business? And the answer is yes. The courts have held that an employee is in the trade or business of being an employee. Why was that important? Because at one time, prior to the tax TCJA in 2018, what could an employee do? They could take business expenses, all right? Oh, I'm sorry, you were pointing to that thing. They could take business expenses, but the TCJA and now HR1, the Act, I don't call it OBER, I call it the Act, HR1, all right? It confirms it forever. And so, yesterday I was listening to Shannon, and she said something about, this is going to be forever. Yes, it's forever until Congress says it's not forever, all right? Remember, nothing is forever, all right? Except death and taxes, as they say, all right? So at one time it was important, but it's not important anymore, okay? So let's assume now we look at someone and we see that they have regularity and continuity, and they're hoping to make a profit. All right, now we have a business. So now we ask ourselves, how can we take deductions away from this income from this business? And the first problem you have when you want to take deductions is you must look at the Internal Revenue Code. God help us, all right? I know that I listened to the first couple of minutes of LG today, and he was talking about the code. The code is the law. You should know the code. Don't rely on the tax book or publications. What should we rely on? The Internal Revenue Code, all right? And what the Internal Revenue Code says is, in Section 263, that if the taxpayer buys something that's designed to last more than 1 year, what are they supposed to do with that asset? They're supposed to depreciate it or amortize it or deplete it, depending upon the kind of asset. That expenses are for things that you write off that have a short life most of the time. So the first obstacle you have in taking business expenses, and this is really important, so I want you to look at the bottom of page 2, is that the norm, what you're supposed to do is capitalize something. But I want you to look at the last 2 sentences. Whether an expenditure is deductible under 162A or is a capital expenditure under 263A is a matter of fact, facts and circumstances, all right? What did the Supreme Court say? There has to be a factual determination. Not what you think, it's what the facts say. So what happens then is when you have a business and someone comes to you when they want to take some things off, you may have to say stop. What happens when it's a close call? A close call between capitalizing and depreciating and so on, and expensing, writing it off in a given year. Who has the upper hand? The upper hand is always Section 263. It takes precedence over Section 162. Why? I'm going to show you in a second, because it's determined by the Internal Revenue Code itself. So understand now, we've determined we have a trade or business, and we're going to start to look to take some expenses to reduce the gross income from the business. First job, is it capitalize the expense or is it deductible? Keeping in mind that 263 is always takes precedence. And if you look on the top of page 3, there's a word in here that some of you love, many of you hate. I was going to change the word, but I couldn't do that and take away the citation. And you'll see the word in a moment, all right? It's from the Third Circuit Court of Appeals, and it's a case called PNC Bancorp. I don't mean to read to you, but the words of these judges are sometimes far more powerful than anything I can say. It is possible that an expense that might appear to be deductible might instead be required to be capitalized. If an expense would fall under the language of 263A, that section would trump the deductibility portion of Section 162, and that expense must be capitalized. You see what it says? 263 trumps over 162. Why is that? Well, we're going to see it in a second, all right? And then there's another quote down there from Indapco. This is a very, very often cited case, and it says, held, petitioner's expenses do not qualify for deduction under Section 162. Deductions are exceptions to the norm of capitalization. So you see which one has precedence is you capitalize things. all right? And are allowed only if there is clear provision to do so. You know, I see some people, I read tax message boards, and I'll often see a poster write something like, they'll ask, is this deductible? I mean, obviously, what does it always depend on? What are the three words? Oh, come on, everybody. It's in circumstances. It always depends on the facts and circumstances. So someone will say, is this deductible? And they'll say, I can't find anything that says you can't deduct it. That's not the way it works, folks. It's only the ones you say you can find something that says it is deductible. You see the difference? All right? That's something important to understand. So the question is, and it says there's clear provision. So the question is, why is Section 263 dominant? Why does it override? I won't use the word anymore because I don't want to irritate anyone. All right? Why does it override 162? It's in the Internal Revenue Code. Look at Code Section 161, which is in your handout. And let's look at what it says, and then I'll explain it, okay? It says, this is 161. This is the actual language in the code. In computing taxable income, what does taxable income mean? Gross income, less expenses, right? That's what you get to that taxable income. It says, in computing taxable income under Section 63, there shall be allowed as deductions the items specified in this part, which is Part 6, I'm going to explain, subject to the exceptions provided in Part 9, Section 261 and following, relating to items not deductible. Now, what does that all mean? Part 6, Part 9. The United States has all their laws codified into something called the United States Code, right? USC, you sometimes will see that abbreviation. And there are what they call 50, they are grouped by subject matter. And there are 53 titles that are in the United States Code. One of those titles, Title 26, is the Internal Revenue Code. All right? So when people talk about Title 26, they mean it's the 26th bunch of laws accumulated by subject matter that is in this wide branch of codification, okay? In the Internal Revenue Code, there are a number of subtitles. My codifier, did you bring your little card with you? You didn't? No. How many subtitles are there, my dear? There are 11 subtitles. She's a legitimate codifier. Second only to me, perhaps. You know, I'm going to say it tomorrow, so I won't say it now. I don't want to take anything away from my presentation tomorrow with Cheryl. But there are 11 subtitles. And what happens is you go from a title to 11 subtitles, and then after you get to a subtitle, you go into chapters. Do you know how many, the chapters, how are they numbered? 1 to 100. So the chapters in the Internal Revenue Code go from chapter 1 to chapter 100. How many chapters are there altogether? Not 100. That's just the way they're numbered. Some of them are missing. Like there is no chapter 8 in the Internal Revenue Code. All right, and there's no chapter 5, I don't think. There is a chapter 2A, capital A. All right, so it's weird, but they go from 1 to 100. They just run along no matter which subtitle they are in. The first chapter in the Internal Revenue Code is called Income Tax, Normal Taxes and Surcharges. That's the first chapter in the Internal Revenue Code. And after you have chapters, you have subchapters. After you have subchapters, you have parts. After you have parts, you have subparts. So what we have to do is look at where we are. So subchapter A in chapter 1 is called the determination of tax liability. In subchapter B, and this is in your handout now, we'll take a look, subchapter B, it's called computation of taxable income. So in subchapter B, computation of taxable income, there, remember what goes now, it's chapter, subchapter, parts. That's the structure of the Internal Revenue Code, all right? Chapter, subchapter, parts. So we are in chapter 1, subchapter B, and there are 11 parts there. And part 6, if you look in the handout, is called itemized deductions. Part 9 is called items not deductible, okay? So in that subchapter B, in the 11 parts, we have part 6 and we have part 9. And what does the code say to us? It says that you can take these deductions in part 6, subject to the limitations in part 9, all right? So you have to understand that. I mean, I don't expect you to run home tonight and you know, start reading the Internal Revenue Code for light reading, all right? But it's something that you really kind of want to understand. If you're one of America's tax experts, that's what EAs want to call themselves, you got to know something about something, right? And it just can't just be, you know, filling out a Schedule A. All right, so on the bottom of page 3, there is section 261. It says, in general, in computing taxable income, no deduction shall in any case be allowed in respect of the items specified in this part, okay? So in this part, which is part 9, and it says items not deductible. Are any of those items not deductible common to you? Of course they are. Look on the top of the next page in your handout on page 4. I listed for you the most common parts, sections, I should say, that are in part 9. And if you look on the top, it's section 262. 262 says personal living and family expenses. What are you not allowed to do with them? You can't deduct them, all right? You can't deduct anything that's found in section 263, which is called capital expenditures. 265, expenses and interest relating to tax-exempt income. 274, is that an important one for you? Absolutely. Where is it? What's in code section 274? The disallowance of taking meals and travel and all those kinds of things without what? Substantiation, all right? Those are the important, and in the tax court, they use 274D a lot. They wipe out expenses because people don't keep substantiation. So if you have a taxpayer that wants to take a travel expense, they better have substantiation for the exception, because as a general rule, 274 prohibits those kinds of expenses, all right? And then you have 280A, which is the vacation home rule. You're all familiar with that. When someone has a vacation home, they use it partially as a residence and partially as a rental. You have special rules there. And of course, the last one I mentioned is section 280E, which is the prohibition of taking business expenses when you have any controlled substances, all right? So we're going to take a look at that because there's some stuff going on there. So does everyone understand the gist of where we want to look? We want to look at what constitutes now expenses that are deductible. And we're going to spend some time looking at that. So the first part of Section 162 is Section 162A, and that is where we find most of our deductions that are going to exist. And take a look on the top of page, where am I? Lost my place over here, not on the top. Take a look on page 4 for a moment at 162A. Remember now, 162 is in Part 6. And what does Part 6 say? Deductible items, right? Isn't that what you have in your thing there, right? So Part 6 is the ones we want, so you can find them, all right? It says, there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on a trade or business, including a reasonable allowance for salaries, traveling expenses, rentals or other properties. Now you notice there's a couple of problems there. Number one, what does ordinary and necessary mean? That's a problem, all right? Believe me, it is a problem, all right? And they only list 3 things. So are those the only ones that you can take off? And of course not. The ones say those 3 were enumerated, but what do we know, for example? Normally, if a business has an insurance cost, can they write it off? Yeah, that's an ordinary and necessary expense. Is it in the 1, 2, 3? No, but that word including says, we're going to give you 3 examples, but it doesn't mean that that's the end of the road. Okay, everybody with me? So the big problem was, and it's an ongoing problem, is the notion of what are ordinary and necessary expenses. And we're going to spend some time taking a look at that. You notice I highlighted the ordinary and necessary. In the Internal Revenue Code, there is no bolding and underlining. And the same thing with the word reasonable. The reason I want to mention reasonable to you, it says reasonable allowance for salaries or other compensation. Where do you worry about reasonable compensation? In an S-Corp, absolutely. In an S-Corp, what do you know you're supposed to take? Reasonable compensation, see? So it's sort of an outgrowth of, you can take it, so take it, all right? Because otherwise you're just trying to scam the system, the game, all right? So what we're going to do is take a look now at what are ordinary and necessary expenses. And in the bottom of the page, it's pretty neat. I think it gives you all the information you'll ever want in that case. And this is called Peters. It says Section 162A allows a deduction for all the ordinary and necessary expenses paid or incurred during the tax year. For an expense to be deductible under Section 162A, it must meet 5 basic elements. It must be ordinary. It must be necessary. It must be paid or incurred by the taxpayer in the taxable year. There must be a trade or business. We hope we've already established that. And the business must arise in conjunction with proximity results from the trade or business. And as the judge points out, those 5 are in a conjunction. In a conjunction, you need all 5 parts in order to have the deduction, all right? Built in, and it's kind of an important issue here, is in addition to being ordinary and necessary, the expenses must also be reasonable, all right? This is something that a lot of folks don't always appreciate, all right? And if you look, there's a couple of cases here which I think you should at least understand the importance of it, all right? And it says, the code says that it's only a reasonable deduction for salaries, but it's built in that all deductions should be reasonable. And if you look in this case called Commissioner versus Lincoln Electric, the Sixth Circuit said, the element of reasonableness is inherent in the phrase ordinary and necessary. It's part of ordinary and necessary. The notion that it be reasonable, all right? Clearly, it was not the intention of Congress to automatically allow as deductions operating expenses incurred or paid by the taxpayer in an unlimited amount. That wasn't the intention. Supposed to be ordinary and necessary, not ordinary, necessary, and extravagant, all right? So keep that in mind. And there's another case there from the Fifth Circuit, and it says the statute contains no express limitation with respect to the reasonableness of the amounts as a condition to deduction. But rentals and other payments for use of property which are excessive in amount, taking into consideration all the facts of the particular case, do not constitute ordinary and necessary expenses. Look at the question there that's in your handout. Look at the question. You have a client that's a lawyer, and the client needs to buy a satchel, carrying case. And so you work for him, male or female assistant, whoever you are, they're a paralegal, and you look online, and he can get or she can get a nice looking quasi leather or, $200 on Etsy. But there's also a $2,500 Louis Vuitton bag. Anyone here an aficionado of Louis Vuitton? Unfortunately, my wife is, but I don't mention that. But seriously now, the $2,500 is Louis Vuitton. $200 is, what do you say? Is it reasonable, the $2,500? And the answer is, well, say it again? Facts and circumstances. Oh, I think you actually said another word I wanted to just say, but you said it depends, right? Oh, it depends. If the lawyer was a Madison Avenue lawyer, would a Louis Vuitton $2,500 bag be probably appropriate? You could make a case, right? If the guy works in downtown Brooklyn out of the back of his car and doesn't have an office, the $2,500 Louis Vuitton seems a little bit of a stretch. Would you agree? So the answer is either take Karen's answer, it depends, or Dan's answer, facts and circumstances. Because facts and circumstances will lead us to it depends, right? I mean, they're the same thing, basically. So, but understand, though, if a person, let's say, has a legitimate T&E account, and they go out and they entertain a client, and they have a thing there for a $2,000 bottle of wine, is that a reasonable expense? Most likely not. But can we say in the absolute? No. Suppose you took out Michael Bloomberg to dinner, all right? Would a $2,000 bottle of wine be appropriate? It might very well be, all right? But you have to understand, just don't let a taxpayer do what he or she wants. There has to be an element of reasonableness in there, because remember, who signs the tax return? A lot of people say, oh, it's ultimately on the taxpayer. Not with me, folks. It's ultimately on me. I make the final decision. If the taxpayer doesn't like it, go scratch. There's other places you can go, all right? I'm not going to do something I don't think is right. So if I saw a $2,000 bottle of wine for a guy that took out, his next door neighbor, and then they talk business, no, it won't happen. All right, so just keep in mind, but the concept is important. It's got to be reasonable, okay? All right, the question is now, what are ordinary and necessary? The ordinary and necessary derive, for the most part, from a Supreme Court case called Welch versus Helvering. This case, it's on the bottom of page 5, is the most cited case in all tax law. All right? It's been cited something like 6,000 times in tax court cases. All right? It's huge. And what Welch did is it established for the first time the concept of what is ordinary and necessary. All right? And if you look on the bottom down there, on bottom of page 5, there's ordinary and necessary in nice, easy language. A trade or business is ordinary if it is normal or customary within a particular trade or business. Now, you got to understand that, because it says it's ordinary if it's in the context of all businesses. Let's suppose someone has a small business has an expense that only happens once in the lifetime of the business. At first glance, you wouldn't say, that's not ordinary, right? If it only happens once in your lifetime, that's extraordinary, not ordinary. But what happens if that same fact pattern happens quite often in the universe of similar types of businesses? Then it becomes ordinary, all right? So you notice it doesn't say it's customary within the business. It says it's customary within a particular trade or business. Everyone follow that? That's what ordinary means. And what does necessary mean? Necessary means it's appropriate and it's helpful. It doesn't mean it's absolutely, you can't do without it. If it's helpful, you would be okay, all right? And so I have some court cases there. You can take a look at them. I want to mention a couple, though, because they have some good words here. If you go to the next page, the concept of ordinary and necessary got followed by another case called Deputy versus DuPont, and they cite Welch, but they have good language here. And it says, ordinary has the connotation of normal, useful, or customary. To be sure, an expense may be ordinary, though it happens but once in the taxpayer's lifetime. See, that sounds contradictory, but if you keep going, yet the transaction which gives rise must be common or frequent occurrence in the type of business involved, okay? Must be current in the business involved. All right, and I think there's a couple cases here I want you to take a look at, because I love the language. I don't know if you know Mr. Robert Kerr. He would be getting goosebumps reading some of these languages. I mean, he's a big legislative grace guy. But if you'll take a look at in DOPCO, that case we cited before, the court has noted the familiar rule that an income tax deduction is a matter of legislative grace. Isn't that wonderful words? It means the fools in Congress said you could do it. Okay, that's legislative grace. The gang of 535, and that the burden of clearly showing the right to the claim deduction is on the taxpayer. And in New Colonial Ice, the court says, whether and to what extent deductions shall be allowed depends upon legislative grace, and only as there is clear provision, therefore, can any particular deduction be allowed. Understand something. There's two concepts in our world. One is gross income, and one is business expenses. They want to be netted against one another to get taxable income. Agreed? But they have different ideas. Gross income is this huge expanse, all right? Everything is in this big circle, except you find something and it says that it isn't. All right? Everybody with me? Big circle. Gross income is everything, except. Deductions are a small circle. Nothing is in there except you find something that says it is. Everybody see the difference between it? Huge, huge difference. All right? Difference in concept, different in results. So understand then, and I like this case called Hyman down there. all right? He notes that as long as a business purpose exists, an expense can be necessary even if it is not required. A reasonable expectation that the business will benefit from an expense is enough for it to be considered necessary within the context of Section 162A. And look at the question on the bottom of that page. And I think it illustrates what Hyman is saying. If you had an AED, you know, that defibrillator, if you own a gym, is that an ordinary and necessary business expense? Of course. You would never think about it, right? Yep, write it off. All right? What happens if you ever own a car dealership? Is that an ordinary and necessary expense? What are you doing? You're not a medical person. But what happens is a case can be made that every business should have an AED. Because if someone, God forbid, you know, was checking a car and passes out when he sees the price, all right, they may have to defibrillate you, whatever they do. Get the AED, here we go. You know, so you understand, even though to own a car dealership, do you need absolutely, is there an absolute need for nah. But is it helpful and appropriate? Yes. Jamie, go ahead. Oh, I'm a mind reader, clairvoyant. Only wish I could read my wife's mind. But
they also may need it for their employees.
Oh, absolutely. But, you know, a lot of businesses don't care about their employees. No, all right. But you're right, though. All right, so let us take a look then. I don't want to beat this to death, but I love it. I got to keep coming back to it. And notice this case in the Fifth Circuit Court of Appeals. It says the statute permits deductions which are both ordinary and necessary. There is not and probably cannot be any exact definition of ordinary and necessary, and each case must be determined on the basis of its own. Oh, come on! Thank you. All right? So you notice what, and that's why I said at the beginning, if someone expects that you're going to give them a list, these are the expenses you can take off. There's no such list exists. It's like the Epstein file. All right? No such list exists, they tell us. All right? Well, this one is real. I don't know about Epstein, but I know this one. There is no list that you can produce because it always depends on the facts and circumstances. Okay? So just kind of keep that in the back of your mind. And I give you an example there why you have to be careful. There's a court case here, what was that? It's pretty recent, right? No, I'm sorry, it was 2010. But there was a case where the business took out a life insurance policy on its employees. Is that an ordinary and necessary business expense? Most of the time, yeah. But what these guys did is they took out the insurance only on 4 principles, all right? Only on the 4 principles. So what the judge looked at the case and said, yeah, insurance is ordinary and necessary, but not in this case. Because you weren't looking to increase the profit motive. What were you looking to do? You were looking to reward these 4 people. So if you're seeing Curcio there, it says, they were not made in the forbearance, these are the insurance payments, of a profit objective or any viable business purpose. Rather, the evidence demonstrates the contributions were made solely for the personal benefit of the petitioners. So, you know, once again, the facts and circumstances control it.
Would the circumstances be different if the business owned the insurance?
I think if the business owns the insurance, there's special rules, Roger. If the business is the beneficiary, then I think it's deductible. Is that right? I don't want to say something wrong, but you agree on that? If the beneficiary is anyone other than, that's one of those key man policies they have. So I believe if the business is the beneficiary, there is a business motive there. It's not personal motive, all right? Okay. So everyone got a clear handle on what ordinary and necessary are, all right? You got your job, all right? So now it's going to take you at least a half hour longer to do every Schedule C you do, right? All right. Now, the problem with 162 is it has a lot of conflicts. And I have some conflicts I want to show you. And one is the conflict in section 262. 262 takes away takes away deduction for any personal expense. 162, they're aptly numbered, huh? 162, 262. 162 allows business deductions, 262 prohibits personal. Quite frankly, you know that often they interject, right? So what we want to do is we want to take a look at how they interject. All right, on the bottom of page 7 there, it says, you see 162 allows, 262 prohibits. So maybe to spice up our conference, they're not going to talk about this over in the other room, I'm telling you. We're going to turn to the topic of sex, all right? So that's going to influence everyone's decision on 162, right? Talking about SEX, right? Matthew's ignoring me over here, right? Okay. There are two cases here. One is a legend. You may have already heard of it. The second one is not so well known. But they both have the topic of other than usual behavior. I don't know why. But you'll see the difference in why one case, 162, wins out, and in the other case, 262 wins out. All right? And the first case, as I said, is legendary. Have you all heard the case of Cynthia Hess? All right? She's also known by the name Chesty Love. Is that now you'll all know, right? All right. So when you say Cynthia Hess, doesn't ring a bell. Chesty Love. Now, notice Dan, the president, perked up when he heard that. All right. So on the top of page 5, let's take a look. Cynthia Hess was an adult entertainer, a stripper, whatever you call it. She danced in a club, all right? And you all aware, whether you go to them or not, I don't know. You've never been in one of those clubs, right?
Wouldn't be caught that.
But seriously, typically women, make money by dancing and exposing certain parts of the entourage here. So Cynthia Hess had a breast implant. She had it enlarged. And when she did her tax return, her tax preparer depreciated her assets, all right? So I don't know what the cost was. The IRS said, no, those are not depreciable assets because whether or not you're using them, they're personal. I mean, you don't go home at night and take them off, They're there forever. So what happened was the IRS disallowed it, and Miss Hess went to tax court. And it was a female judge, all right? And she was able to convince the judge that she increased her bosom size to such a degree that it had to be business related, all right? And if you take a look, these are some of the facts that are in here. She showed the court that her wages or her tips, whatever, no tax on tips, so she'd be in good shape today, that her earnings doubled after she did the enhancement, all right? And so the judge was impressed by that, but it also turned out that because of the enormous amount of increase she did, she went to a 56 double F bosom size. I don't know what the hell that is, but it sounds big, 56 double F. And then later on, she went to a 56N, all right? And it was a nightmare physically for her. She made a lot of money, but she couldn't walk, and there was a column by George Will in Newsweek. He talked about it. I mean, that's how strange it was during the time, and that the woman actually, her imbalance made her fall over, and she fell on the ice once, and one of them ruptured, and she had some serious problems. But the point is, even though 262 would normally seem to control, she was able to show the judge that this was truly a business asset. Now, I know a lot of people, when the case came out or subsequent to it, all of a sudden they went, every woman that worked in adult entertainment wanted to depreciate assets. But this was unique because of the size. And what does it always depend on? Some circumstances, all right? So in any case, the judge ruled that even though it appeared to be personal, because it's in your body, look at what the judge wrote. The implants were detrimental to her health and contorted her body into a grotesque appearance, all for the purpose of making money. Thus, even though the implants were surgically made part of her body, we are convinced they were not inherently personal in nature. So there's an example of where 162 beat 262. In the second case, this case is called Vitali. All right? He was actually a former employee of the Treasury Department. I don't know if he worked for the IRS or not, but he worked for the Treasury Department. And he wrote a book. And the book was called Searchlight Nevada. All right? And in his research, he wrote off interview expenses with prostitutes in a brothel. All right? So, do they seem like a business expense? Yeah, on the face of it. Oh, I spent this money so I could do research. But what did the judge say? The judge said, there's a close call here. 162, 262. And the judge said, sorry, these interview expenses are so personal in nature that they can't be deductible, because what always takes precedence? Part 9, 262 over Part 6, 162. All right? You all with me? So the judge writes, we find that the expenditures incurred by petitioner to visit prostitutes are so personal in nature as to preclude their deductibility. In evaluating whether certain expenses are personal or qualify as business expenses under Section 162, the court has found that some expenses are so inherently personal that they almost always invariably are held to come within the ambit of Section 262. All right? So when there's an opposition, remember, 262 is going to override. And the last thing I just want to mention before we push on here, it's on the bottom. If you have some aggressive clients, you may want to show them the case of Donald Fletcher. Donald Fletcher tried to take expenses that belonged under 262 and make them into 162 as a general rule, all right? He wound up being sentenced to 71 months in prison, federal prison, so maybe show it to your clients and they may say, maybe I won't do that after all. But look at what the judge wrote on the 8th Circuit on the top of page 9. It says, Mr. Fletcher explained the whole secret that we're talking about is to convert personal expenses into business expenses. Can you do that? No. 262, 162. We all got that in our heads? This guy tried to do it. And he said that he told clients that accountants and attorneys were not trained and his method was not taught at business schools. All right? And the judge said, I don't think this is going to work, because he was advocating deducting a cat as a rodent control device, all right? Dog food as a security device, and even a bird as aerial surveillance, all right? So I don't think, Mr. Fletcher, but the problem is your clients, they talk to the barber, they talk to the hairdresser, the barber tells them everything, right? My barber knows more than God, I tell you, man. James, you know that guy? Oh, yeah. You know that guy? Yeah, 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 yeah. All right, so, and whether you know it or not, it sounds like a good case, all right? The last thing I just mentioned about 262 and 162, there are a lot of these now in this area, the tax court cases are earlier, prior to the TikTok area, right? You have these, I hate this word, two words, social influences. What the heck are they? All right? Social influences, they have an image to maintain. They want to write off everything because it's part of their image. Can you write off everything? No, because most of it is not part of your business expense. It's part of your personal expense, all right? I mean, there's been a gazillion cases, but I'm telling you, there's really no case law on TikTok and social influences, but you got to use your head, and you just got to tell people no, all right? It's not worth, I don't know what you charge for a tax return, $300, $400, whatever you want to charge, all right? $4,000, I don't care. It's not worth it. Aggravation, and it can come back to bite you. All right. Okay, on bottom page 9, I want to just quickly mention a little bit about the conflict between 162 and 183. What is 183? 183 is a code section that says this is an activity not engaged for profit. What do we call them? Hobbies, all right? And what do a lot of people feel? A lot of people feel that their hobby is a business. Is it important to make a difference between the two? Absolutely. Because if you have a business that has a loss, what can that loss do? It can offset your ordinary income. If you have a hobby that has a loss, what's the only thing you can offset is your income, maybe, but now probably not. All right? Why? Well, let me just give you one fast question. Person has a hobby, got $1,000 in gross receipts. They make widgets. The material for the widgets was $300. Their business expenses were $200. How much is their gross income? Oh, he said 700. Everyone else? Everyone agrees 700? You sure? 1,000? 300 for cost of goods sold, 200 business expenses. I'm sorry? Right. How much is the gross income? 1,000. Just the gross. So 700? Anyone got a 500? No one's got 500? Really? 1,000, take away 3, take away 2. Oh, very good. It's not your gross income. What's your gross income in a hobby or a business? You said it first. 700. It's 1,000, take away the cost of goods sold. What about those $200 of business expenses? They are, so what do you put on your tax return? $700 of income from a hobby. What about the 200? They're Gonzville. All right, but where do they go? They go, the TCJA, followed by the Act, said they don't exist anymore. Those were subject to the 2% rule in Code Section 67, all right? So they don't, so a person that has a hobby, if they tell you the truth, all right, it's screwed. I mean, just they can't take off their thing. And even if they had a lot of business expenses, same example, But suppose their expenses were, they went to some craft shows and they had to pay the entrance fees. And their expenses were $900. Do they make any money? What are they going to pay tax on? $700, even though they made no money. Fair? Who cares about fair, right? I mean, seriously, fair is not something that we worry about. We worry about doing it the right way. But just keep in mind that that's an important thing. And I just want you, this is really kind of interesting on the next page. I just want to get to this. If you look at section 163, they talk about the deductions. If you see deductions allowable, in the case of an activity not engaged in for profit, there shall be allowed, 1, deductions which are allowable under this chapter. What does that mean? Real estate taxes, mortgage interest, they're going to come off no matter what, all right? And the deduction which will be allowable under this chapter only if such activity were engaged in for profit, business expenses, but only to the extent the gross income from such activity exceeds the income. Now, the question is, we know that the business expenses are not deductible. There was a taxpayer only a couple years ago that said this. Well, let me ask you this. How did you know that the expenses under Section 183 belonged on Schedule A? How did you know that? Because you've been told that. And it's always been like you've been working the things out. But what this taxpayer says, and remember, there are two, and Ryan mentioned it yesterday, there are two, I think he mentioned it, there are two types of deductions. One is above the line, which, what does that do if a deduction is above the line? What does it reduce? Gross income. And the other deductions are below the line. What do they reduce? Taxable income. Which is more valuable? Above the line, without a doubt. Because what does everything depend on? Think about all the things that depend on AGI. So what's your goal? Reduce AGI. So this taxpayer had a hobby. And when they did their hobby, they took their business expense, their hobby expenses, and made it above the line. The IRS said, no, it's below the line. And it was the first time ever, and this is in the year 2023, just very recently, that an appeals court looked at the right answer. Is this really above the line or below the line? All right? And the court made the determination that it was actually below the line. But it's really interesting when you look at it. All right? On bottom of page 10, the expectation is, it's the first time it's ever been done. So, and what the judge said, he says, we know, everyone agrees you get a deduction. And the question is, where does it go? So this settled it now, that there is no more ambiguity, all right? I know you can technically argue that it's one circuit court of appeals, but, no one's going to take this case on anymore, all right? It is a below-the-line deduction, all right? And it's subject to the conditions in Section 67, the 2% rule. So people are out of luck. Sorry about that. All righty. Next conflict. Next conflict would be over on page 11. I just want to mention this for a second. There's a case I gave you in the hobby. It's so obvious, I'm not going to go over it in the interest of time, but I'm sure tonight when you're on your way home, you'll be reading some of these things and making sure you got this all down, all right? In any case, I want to talk a little bit about 280E. 280E is the controlled substance problem. And you know that people that engage in this cannabis industry are really at a disadvantage, right or wrong. I'm not making any judgment. But 280E says that you cannot take any expenses, business expenses, against your gross income, all right, if you deal with a controlled substance. And a controlled substance is defined, in a way that marijuana is still there. I know that there was a pronouncement that came out, I think from the Department of Justice or something, that they were reevaluating that and seeing if it belongs as a controlled substance. But in any case, it became a big deal because I don't have to tell you, no matter where you live, the cannabis industry is huge. Governments are falling over themselves to create the shops because what does it involve? Lots and lots of money, all right? They're collecting these fees off the sales, and it's putting it, whether it's right or wrong, I'm making no judgment on it. I'm simply saying that a lot of government activities are doing it, all right? So after the Department of Justice published this, what a number of cannabis people did is they filed amended tax returns. And what they said was, what they do is they get an opinion letter from a law firm that based on the language, there is some, I don't have to tell you the minutiae of language, whether it be in the Internal Revenue Code or in contracts or in laws, where the comma goes, or if it's an or a the, or, so they said that looking at the Controlled Substance Act and the other act that involves, I forget the name of it, there were slight variations, and that in fact marijuana doesn't belong there. So these people were getting an opinion letter from a law firm saying that the language in the Controlled Substance Act didn't lead to the conclusion in Section 280E, and they filed an amended return to get their money back. In order to do that, what do you have to have in order to file a tax return? Mr. Travato, what kind of basis do you need? Reasonable basis. So what do these lawyers say to tax preparers? How do you have a reasonable basis in order to avoid penalties? What do you attach to your tax return? My favorite tax form, a Form 8275. And 8275 is a disclosure. And what is the disclosure supposed to do? Protect you and the taxpayer from certain kinds of penalties, all right? But the IRS came back and said, sorry, the Department of Justice was a proposal we're looking at, but as of now, what is the status of marijuana? It is deemed to be a level 1 controlled substance. And if you do the 8275, it'll be meaningless because what don't you have? You don't have a reasonable basis. All right? You see that? You need a reasonable basis to to sign a tax return as a tax preparer. If you don't have it, you open yourself to all sorts of penalties. All right? 8275 protects you if you have the reasonable basis, but this says you don't, all right? And if you look on page 12, you'll see that there's that fact sheet from the Internal Revenue Service. It was only in December of 2004, and it says some disclosures received with respect to 280E lacking a reasonable basis. I just want to mention this to you. We're not going to spend a lot of time because we've still got a few more things I want to cover here. And that is this case that's in the tax court right now. It's called New Mexico Organic. This is on the bottom of page 12, all right, or midway down. And a lot of people in the cannabis industry are looking at this case because the guy who's litigating is a former Department of Justice attorney who won a lot of cannabis cases for the government. He's now a defense lawyer, or I don't know, defense lawyer, whatever kind of, he's now in private practice, all right? And what he's doing is he's making an argument, two arguments actually, that haven't been made before to see if you can have business expenses under 280E, all right? And if the two expenses, if you take a look at them for a moment, on the bottom of page 12, the first argument, he says, that marijuana is not within the meaning of Schedule 1 or 2 of the Controlled Substance Act because it does not satisfy the statutory criteria. Because 280E doesn't say, now listen to what I'm saying, doesn't say substances listed on, but rather uses the words within the meaning of. You see what, and he may have a correct argument, you know? He may have a correct argument, but what he's arguing is that marijuana doesn't need the Department of Justice. It doesn't belong on a list in the first place because it doesn't satisfy the language in the statute, okay? Everybody got with me on that? The second argument is an interesting one, and this one only applies to medical marijuana, all right? And under New Mexico, similar to New York, you can have marijuana purchased legally for medicinal purposes. Well, it turns out what their argument is that if it's medical marijuana, it's not subject to federal or state law. Clearly, in New Mexico, where it's legal, it's not against state law. But how does that change with federal? Well, what turns out, and if you look at, it's really interesting, if you look at the bottom of page 12, since 2014, Congress has prohibited the Department of Justice to prosecute medical marijuana businesses. They haven't given them the funds since 2014. So what the lawyer's argument is, if Congress has stopped funding the ability to prosecute, what has Congress tacitly said? This is not a controlled substance. Does that make sense to you? I mean, I don't know whether legally it's going to stand up, but that's his argument. And, it could seem kind of controlling to me, but who knows? The tax court will take forever to look at it, and we'll see.
It is medical marijuana.
Yes, medical marijuana, right. Not just general, right. So what'll happen is a lot of businesses, of course, will bifurcate, all right, in order to do it. And I just want to point out something to you very important on the top of page 13. When we say that 280E does not allow expenses, it doesn't refer to the cost of goods sold. If you have a cannabis industry, the cost of goods sold is mandatory to take off from the gross receipts. Because look at what, this is notice a case that was from 2023. It says, by contrast, the reduction of gross receipts by the cost of goods sold is mandatory, not a matter of legislative grace. Mandatory, not legislative grace. As what does the 16th Amendment only allow? It only allows taxation on income. So if you have a cost of goods sold, your income is the receipts less the cost of goods sold. So keep that in mind, okay? Let me just check my time here. All righty. And I just want to point out to you, one of the things that you have to be careful of here is, it doesn't mean if you have illegal activities, you can't take expenses. It's just the 280E. So there's a case here called Chang, which is just this past year, all right? And what the taxpayer took $300,000 of expenses been fighting a criminal activity that came from his business. The IRS disallowed it as a personal expense, but the judge allowed it because of the fact that, what do you call it? Where am I? It was part of his criminal business, even though he was a criminal. Just like Al Capone, what did they get Al Capone on? Not reporting his income. Well, if you report your income, what do you also got to be allowed to do? Take off your deductions. So it established the thing. So I found this pretty interesting quote. But anyway, but there is one other thing in Section 162C, which explicitly, so it's not open to question, prohibits the deduction of any payment that constitutes an illegal bribe, illegal kickback, or other illegal payment under any law of the United States or the law of any state, all right? So there's a fellow that writes a lot of articles. I don't know if you ever read them on procedurally taxing, I think it is on now, called Brian Camp. So he said, I liked it. He says, the taxpayer in the business of fencing stolen goods can deduct their reasonable office rents, but they're not allowed the cost of bribing law enforcement and then talk the other way. So it's a sort of dichotomy you have in an illegal activity. You can take off some things and not the others. All right, in Section 162F, it talks about fines and penalties. This has had a mixed bag, and you have to be careful on this. In a case from the Supreme Court called Turk Rentals, they disallowed a deduction to take away any kind of payment of fines or from the government. The idea was they have this public policy doctrine. They say, how can we allow you to have a deduction against something that's against public policy? You're doing something wrong. Why should we let you take a deduction of a fine? We fined you because you did something wrong, and now we're going to let you take a tax deduction? So the Supreme Court agreed with that in this Turk Rentals. But a few years later, they had a fairly similar case, and they changed a little bit in a case called Telia. And what they said in that one is this guy was very similar to that Vilma that I just mentioned to you, that the guy spent X dollars defending himself in a criminal case, all right? And they said, you got to allow it. This is not a fine as it was intended. He's protecting himself. He's defending himself against personal harm. So what happened then is Congress changed. They amended Section 162, and it became a bit of a problem. If you look on page 14, they about halfway down the page, TCJ amended 162F, and it provides that no deduction shall be allowed, amount paid or incurred at the direction of a government or a governmental entity in relation to any violation of the law. But what they also did at the same time, they put in an exception. And the exception is you can take the fine off as a penalty if the penalty is designed to be part of a restitution kind of rehabilitation. So like during COVID, if the health department came in and found something wrong with in a delicatessen, and they said, we're fining you $1,000 because your refrigeration is not good. If the business owner corrected the problem and got new refrigeration, then that $1,000 is going to be deductible, all right? So what they created then is this thing, and we're not going to spend too much time on it because I don't know if you've seen this at all, but under the exception, the general allowance rule to not being able to take a fine or penalty, you have to have two things. The taxpayer has to establish the amounts were paid or incurred as restitution to come in compliance with the law. They call that the establishment requirement. You have to establish that this is what the expenditure was. And the second thing you have to do, the amounts are identified in a court order or settlement agreement as restitution or amounts to come into compliance with the law. The identification requirement. So you need two things. And what the government did was, at the same time, they added a new section to the tax code, 6050X, which required people that received fines to send in information reports to the government. And if you look on the top of page 15, IRS issued final regulations. I don't know if you've ever seen this, but if you have a fine or a penalty paid to a government, if it's $50,000 or more, the government is required to send a 1098-F form to the entity that paid the penalty. It was originally written to be $600. That would have been a huge, huge mess. So now, if it's $50,000 or more, they are required to do it. There is a chief counsel advisory there. I'll let you read through that. That illustrates the difference between that you need to satisfy these requirements, big time. Establishment and identification, you need to do both parts in order to take the fine as a deduction on your tax return. So the general rule is, if you have a fine, it's not going to be deductible. All right, and the last thing we want to do, we have about, 15 minutes, 20 minutes? 20 minutes. Let's take a look a little bit at section 162Q and a couple of sorted other items that go along with that. Section 162Q came from the Harvey Weinstein era. You all remember Harvey Weinstein, all right? What was happening is, Weinstein was a slugger, right? I don't think anyone wants to defend him, but, he was sexually abusing women and what have you. And but what happened is it became more common in the workplace and in a lot of companies. It wasn't have to be Harvey Weinstein. It could be the one of the bosses pinching the butt of his secretary. I mean, I'm not going into gory details here, but you know what I'm driving at. It didn't have to be on the magnitude of the thing. So some people would bring a suit, and obviously the business, certainly the boss, or middle-level boss, high-level boss, who cares, may not have wanted to know, let it be known that he was, and it's typically, and I say he, I mean it can be the other way too, but typically it was a male and a female was abused. And so what they did is they signed these non-disclosure things, all right? And so what was happening was businesses were guilty, if you will, or certainly employees in the business, were guilty of this sexual harassment or abuse or whatever you want to, the level it was. And they were writing off the expenses that they paid, the settlement money, to the victim or the person that was the subject of the abuse. So Congress didn't want that because if it's non-disclosed, we're not going to let you do it. So what they enacted is Section 162, and it's subsection Q, and what it did was it created an obstacle to take legal fees as a deduction if it was non-disclosed, all right? And I want you to just take a look, because this is really kind of interesting. Anytime you have legal expenses as a business expense, it's a problem. because, people like, I don't do any more business returns anymore, entities, but you'd have a guy write $2,000 lawyer fee. Whoa, what's that? Then it turns out that it was something personal. So, sorry, Lou. And people, so lawyer fees are always a problem. But there's a really kind of interesting concept I just want you to see. I don't know if you've ever seen this before. It's in a Supreme Court case called Gilmore. And take a look on page 16 at Gilmore. And here's what the court wrote. For income tax purposes, Congress has seen fit to regard an individual as having two personalities. One is a seeker after profit who can deduct the expenses incurred in that search. The other is a creature satisfying his needs as a human and those of his family, but who cannot deduct such consumption-related expenditures. Is that a fancy way of saying 162 and 262? I think so, right? Fancy way of saying that. So what the court said was, you got to be the first type to take a legal expense, all right? Because that's the 162 guy. So what they did was they looked at the origin of the claim, and in this case, they decided that Mr. Gilmore had the second personality. Why did they make that determination? Because the expenses were for the purposes of divorcing his wife, all right? So, therefore, the second personality came into being. Now remember, that's back in 1963, so that's a long time ago. It's still good law, but it illustrates the problem. So in any case, after this, the Weinstein thing came about, and it was 162Q, and the payments related to sexual harassment and abuse, and no deduction shall be allowed for any settlement or blah, 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 is subject to a non-disclosure agreement or attorney fees related to such a settlement or payment. The Internal Revenue Code had that, and that's the law. But what happened after that law was written and signed? People asked some legitimate questions. If you're Harvey Weinstein, and you had those legal fees, and it was non-disclosed, you can't take it off. But what about the woman who brought the suit? She was victimless. Oh, no, is that right? She was guiltless. Not victim, sorry. She was guiltless. And yet she's getting screwed by the same kind of language that Harvey Weinstein is getting screwed by. So there was a big concern. The law's never been amended, but the IRS has created they issued a statement, and you'll see it on the top of page 17. Does Section 162 preclude me from deducting my attorney fees related to the settlement of my sexual harassment claim if the settlement is subject to a non-disclosure? No. Recipients of settlements related are not precluded by Section 162Q from deducting attorney fees related to the settlement or payment. Look at the last three words. If otherwise deductible. Are they deductible? Probably not. Because what does TCJA for 5 years do, and now what HR 1 does forever? Maybe. All right? They preclude 2% miscellaneous deductions. So if a woman has a $25,000 legal fee, she's out of luck. The only time you can get legal fee relief is if you fall under the ambit of Code Section 62A20. In 62A20, if the suit is a discrimination suit, or in those types of suits, then this law specifically allows you to net, all right, the attorney fees from the thing. So if you got $100,000 settlement, and you paid $30,000 to the lawyer, what can you put on your tax return on Schedule 1? $70,000. If it was just a regular sexual harassment case, you get $100,000. What are you going to put on Schedule 1? And you still pay the lawyer $30,000? You're getting $100,000. You can't do anything with attorney fees, all right? Fair? Once again, it really doesn't make any difference. I just want to mention to you, some people say, well, gee, aren't all these things tax-free? Sexual harassment, sexual abuse, aren't they tax-free? Isn't there a preclusion in the code? No? In the Internal Revenue Code, in Section 104, there is a bunch of exclusions from gross income. That's where workman's compensation is excluded in Section 104. And what they have in Section 104 is a section that you can exclude from gross income, a legal settlement, if it is a result of physical, personal injury or sickness. Emphasis, physical. Supreme Court, in a case called Schuyler, back like in 1993, said it was personal injury, you could do it. But then in 1996, in the Small Jobs Business Act, Congress amended that, and they said you must have physical injury or sickness, all right? So a woman, and I'm not trying to minimize this, please don't, but a woman that, the boss smacks her on the butt, I don't know if there's any physical injury there. You know what I'm getting at? I don't know where to draw the line. I'm not trying to minimize anything. Don't understand that. But that we would not feel was physical injury. What about emotional distress? Well, emotional distress, a lot of people think if you get a settlement for emotional distress, that's tax-free. And as a general rule, that's wrong. It is not tax-free, all right? To be tax-free, it has to result from physical personal injury. And if you look, I put the code section in there for you, because this is really kind of important. On the bottom of page 17, it says compensation for injury or sickness. In general, gross income does not include the amount of any damages other than punitive damages. Punitive damages are included in gross income. Received whether by suit or agreement, there was whether a lump sum or periodic payments on account of personal, if you got a highlighter, physical injuries or physical sickness, all right? You have to understand that. And if you look at the last couple of sentences in Section 104A, look what it says. For purposes of paragraph 2, that's the one I just read to you, all right? Emotional distress shall not be treated as a physical injury or physical sickness. Excuse me. Emotional distress not treated as a physical injury or physical sickness, all right? The only exception to that is if you have emotional distress and you go to a doctor and you have medical expenses. So let's suppose a woman gets a settlement for emotional distress of $40,000. She went to a psychiatrist and paid $8,000. How much does she have to report, and what is her thing? $32,000, because the medical, the Section 213 deduction offsets the 40 grand, all right? But that's the case. If there is physical injury, then the emotional distress goes along with it. You don't bifurcate it. But by in and of itself, it doesn't work that way, okay? And I want to do one more thing that's current, but just also mention to you, you can take a look at a couple of chief counsel advisories here. At one time, the IRS took the position of what some people call the bruise rule. A woman couldn't assert she had sexual harassment or sexual abuse unless you could see the bruises on her body, all right? That was an original one. It came back, and later on in the year 2008, they made a more, especially when there were children involved, that they would accept that it was physical injury, because you can't expect a child that was abused 5 years ago to come and say, yo, here's my physical injuries. I mean, it doesn't work that way, all right? But understand, emotional distress is generally taxable to you. All right, on the last page, I want to mention this to you. There is a bill in Congress. It's bipartisan. And in New York, Senator Gillibrand is a co-sponsor in the Senate, and Congresswoman Tierney, I think she's up here in the Albany area somewhere, she is a sponsor in the House. And it's called the Tax Fairness for Survivors Act, all right? And what it would do, and I'm going to tell you something in a second, when it was introduced, it would add a new section 139J to the Internal Revenue Code. And it says, amounts received as judgment, awards, and settlement with respect to sexual assault or sexual harassment. All right? In general, boom, boom, boom. Gross income, but here's what the key is. Gross income is not going to include these damages, including punitive damages. Now, when someone dies and they get a settlement, are punitive damages included in their gross income? Yes. They're going to say now, I'm not trying to minimize, but someone has a settlement for a sexual harassment, they're going to say the punitive damages are excluded. That's a big step to go from one to the other. I don't know. It hasn't gone anywhere in either place. It was referred to committee. And you know what happens when you refer to committees, right? I don't have to tell you, all right? But I do want to mention something to you, though, that's important. When I introduced this bill, it was introduced as 139, Section 139, Cap J. But an H.R. 1, a.k.a. OBA, there was a new 139J, there was a new 139K, and there was a new 139L. So this bill, if it ever goes anywhere, won't be 139J, it'll be 139 M. It'll be 139M. JK, yeah, all right. And the three of them were, those were one was the Trump accounts, one was the scholarship thing, and there was another one, very esoteric, exclusion from gross income of interest. All right, so I think the important point, though, for me, is I'm all in favor of, if you get the settlement, but not having a gross income, but the difference in the punitive damages is quite drastic. All right, so let me ask you, did everybody learn something today? Yes. All right, good. I think our time is up. Enjoy your lunch. Cheryl and I will see you tomorrow at 10:30, okay? And have the rest of the day.